The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. And with me today, as always, is my Chanticleer colleague, and he's certainly got my endorsement as the next president of the Chook Pen. It's Anthony McDonald. How are you, Anthony?
Thanks, Joe. James.
Fantastic. Well, this week we ask why everyone's suddenly sceptical on AI. We try to fix Australia's capital markets, and we look ahead to the biggest economic data release of the year. But first, Anthony, on Thursday morning, we had a June quarter update from the company affectionately known as the Millionaire's Factory, Macquarie Group. What did we learn?
Well, we learnt that the profit machine's still stuck in second or third gear. I think, James, it's a bit more of the same. Don't get me wrong, this thing still makes a ton of money, but that breakout year that it had in the 2023 financial year when it made more than $3 billion profit, it's looking pretty hard to top this year, I think, as it was last year. So until the deal markets reopen, as much as Macquarie talks about itself now as an annuity business with all these safe annuity income streams, it really is heavily reliant on transactions. And until buying and selling gets back to normal, and that's whether that's Macquarie acting as a principal, as a fund manager, as an advisor, whatever, until that activity gets back to normal or more elevated levels, I think the profit's still a little bit slow. Don't you think, James?
Yeah. What we've heard out of the US investment banks over the last few weeks during the June quarter reporting season in America is a little bit more optimism about deal making. And so I asked Shamara Wickranamayke, the CEO of Macquarie, hey, hang on, I thought we were supposed to be feeling better about deals, and she just poured cold water on it.
Really?
Basically said, that's America, where Australia's behind that, and it's really only a whole bunch of debt deals rather than M&A. So don't get too excited about that. It's still tough out there. Macquarie still reckons they can sell some green assets and a few other assets on their balance sheet in the second half of the financial year. They're still pretty confident about that. But yeah, Shamara was quite, not downbeat, but I think realistic about where we are in the world and the fact that deal activity's not that strong.
James, we saw another powerful female leader in the spotlight this week, with US Vice President Kamala Harris now firm favourite to become the Democratic presidential candidate after poor old Joe Biden took himself out of the race. James, she's in her honeymoon period, a few days in, but there's certainly new energy in the contest now, isn't there?
Absolutely. All we were talking about this time last week was Donald Trump and J.D. Vance and, Hulk Hogan introducing them to the Republican convention. But all of a sudden, the stories about Kamala Harris. Now, some of the stories are, is she up to it? Can she change the course of this race? Does she engender the same level of support as Joe Biden? But the conversation has changed. I'm with you. I'm not sure how long that lasts, but it's interesting to see a sort of new energy in the contest. And look, she certainly seems like she's going to put up a better fight than poor old Joe Biden, who he did the right thing, didn't he? He took him a while, but he finally got there.
He sure did, James. And the good news for Kamala Harris is she's got 3 or 4 weeks now to the Democratic National Convention. It'll be big news, August 19 to 22, I think it is. And always, she should get heaps of attention. She should come out of that looking quite good. So, that's a few weeks away. She's got a while to sort of get it all together, make the most of this early momentum, and then see if she can make a difference come November 5.
Yeah, absolutely. Anthony, just super quickly, we've been covering on the podcast for a while now the ANZ trading scandal story that John Shapiro and Aaron Patrick have been covering brilliantly. We had a major update on Thursday. Just tell us what happened there.
We did. So ANZ's tried to draw a line in the sand under it. So they've been doing their own review, which they say sufficiently progressed enough for them to rule themselves out, basically, of manipulating the market, which is the biggest of the allegations against them at the moment. Now, it's a pretty brave call from ANZ. This story has run away from them since the start. The amount of leaking out of ANZ's just been insane. So they've been trying to catch up. So they've been running their own review. They now say their review's sufficient to that they haven't breached the law, and that would be good news for ANZ. I mean, the problem is, though, we only heard from the ASIC chairman a couple of days ago that their investigation's still underway. And if there's one thing we know about regulators, it's their investigations are the ones that tend to, A, have the most power, but B, at the end of the day, they're the ones that matter, right? So ANZ's trying to tell us it's all sweet, but I think we'd be best off waiting to hear that from the regulator's mouth.
Yeah, and that the all clear from the regulator, should ANZ get it, that's months away. I mean, investigations like this will take forever. So this story is far from over, and ANZ CEO Shane Elliott, he'll be talking about this till early next year, I reckon.
Yeah, I agree. I mean, the one thing that we did see today, I mean, he's talking about personal accountability, which straight away we read that as his job was on the line. But I think he means more, okay, I'm going to take a hit to my bonus if this is right. But if ASIC then comes out with these charges, I think we'll find his job goes pretty quickly.
Yeah, plenty more to see here.
Well, James, let's move to our first topic. And on Wednesday morning, you had breakfast with Elon Musk. Well, he was in Texas and you were in Melbourne, but you tuned in to listen to Tesla's June quarter earnings call and hear what was on the mind of one of the world's most magnetic billionaires. But old Elon had a bit of a problem that sums up one of the big themes that spread across the markets in recent weeks. He's talking a big game on artificial intelligence, but investors are getting a bit impatient. James, you were talking to me about this at the start of the week, and then Elon's just jumped on the back. What did we learn from Elon Musk?
Yeah, well, I think we learnt that Elon's a very blue sky guy. Very big picture. Don't worry about the noise. Don't worry about the fact that Tesla sales are under a bit of pressure. Don't worry about the fact that there's Chinese competitors coming after Tesla's margins. Don't worry about politics. Don't worry about tariffs. Don't worry about Donald Trump. All of that doesn't matter because Tesla is about to solve AI and become a robo-taxi company where, there'll be like Teslas running around that will be able to summon, driverless cars at our whim, and that'll be fantastic. And it's also going to become a humanoid robot company. So, there'll be human-looking robots in shops and in factories everywhere, maybe even in our houses. So everything else pales into comparison. Elon's saying, if I can get this right, this company could be worth anything. And basically his message to the market yesterday was, if you don't believe me, sell your shares. I don't want you as a Tesla investor. You shouldn't be a Tesla investor. So either you're on Team Musk or go away. And guess what, Anthony?
What?
That's exactly what shareholders did. They saw this profit result. They listened to Elon, and the shares were down 12%. People are just not sure that this is the big promise that he's making is what's going to eventuate. They're not sure. They've been hearing about robo-taxis for 5 years, and it's always just a little bit out of reach. There was supposed to be a robo-taxi investor day in August. Guess what? It's just been pushed back to October. Everything's just a little bit out of reach, and that's what everyone's starting to think about, all this AI hype. Yes, the money's being invested, but are the earnings coming from that just a little bit out of reach?
Yeah, James, like I said, I don't know what you did last weekend, but first thing on Monday morning this week, you said to me, gee, I'm a bit worried about this AI story. and this week, sure enough, it's happened. And as we said, like this builds on a theme that we're seeing across markets. There's no doubt that AI is exciting. There's no doubt that billions are being invested in it. But yeah, the market's starting to worry that earnings aren't going to come through, aren't they?
Yeah, there's just so much money being invested. I mean, the estimate from Goldman Sachs is that there's about $1 trillion being invested in AI infrastructure, AI applications, all the chips, everything to do with AI. But the question that Goldman Sachs raises, I think they put it nicely, what is the $1 trillion problem that AI is trying to solve? Now, and their view is that there's really no cost-effective solutions that AI has been able to come up with yet. Now, the yet is the important part, right? We might only be months or weeks or maybe a year away from AI cracking some big productivity nut in business, and we'll all say, well, the skepticism was wrong. But the concern is that this AI story has been building for a few years now. We haven't seen the killer app or anything really like the killer app. There's just so much human involvement required to solve complex real-world problems. So is AI going to get where it needs to go? I mean, the problem here, though, is that the market's been so fixated on these AI companies. They've pushed the valuations up so high. If just a little bit of doubt creeps into the market about the promise of AI, then we could see a correction in shares or at least a reversal in the rally that we've seen. So it's really becoming a bit of a rubber hits the road moment, and that's what we saw with Tesla. But Anthony, it leads me to a pretty good question. Are you using AI? And is it saving you time or money?
I'm probably the wrong person to ask, James. Or maybe I'm exactly the right person to ask
Exactly.
this week. Not really. Like I feel like I'm still stuck in the physical world, and that's probably why I'm not really going anywhere. Or perhaps it's so seamlessly integrating into my life that I haven't even noticed. So no, James, I don't think, like, you know, while Nvidia's share prices run, while Amazon, Meta, Tesla's run too, I don't think day-to-day life has changed just yet. And maybe that's at the heart of this whole issue.
I use a little bit of AI in, for when I record an interview, you get an AI-generated automatic transcription. It's actually pretty good. It's a service called Otter. But beyond that, I've played around with ChatGPT a bit. I just haven't found the thing that really helps me in my job. And I wonder if lots of people are like that, and we'll see how it develops. I mean, we've got reporting season coming up in Australia over August, over the next sort of 4 weeks. And last reporting season during February, Anthony, companies were falling over themselves to say, oh, yes, we're using AI. Do you think we'll see the same level of excitement in the coming month?
I think it's still exciting. And, you know, like Commonwealth Bank of Australia boss Matt Common said a few months ago, well, made it clear a few months ago, you've got to be thinking about it if you're running a company. Yeah. So I think we're definitely still going to hear a lot of people talk about it, them thinking about it. But I'm not sure the use cases or exactly how it's going to be used has been defined just yet. Apart from that thing we've been hearing about forever, which is about data, making the most of data, trying to get more out of data, use our data, service customers better with data. Apart from using large language models to go through that data, I'm not sure we're seeing it too much. And I mean, if you look at the companies that should be at the forefront of it, say like your WiseTech Globals, right? It's a software company. We hear that AI is going to change software development, and a group like WiseTech at the forefront of technology should be the ones that are leading us to this new era. If you hear Richard White talk about it, I mean, even he says he's using it in bits and pieces. He's mucking around with it a little bit, but it has not changed their business completely yet. And I'm not sure that it's going to in the near term either.
Yeah. The interesting thing the Goldman Sachs guys say is there is a bit of a catch-22 here, because if you're a company out there, you don't want to be left behind. You've sort of got to invest a little bit at least to make sure that you're in and around AI, that there's a little bit of corporate FOMO in this. So, look, that could keep the AI hype and excitement and investment running for some time, but we're still searching for that killer app, I reckon. All right, Anthony, let's move to our second topic, and let's try and solve the world's problems, or at least fix Australia's capital markets. Now, it's a quiet week on the corporate calendar this week, stuck between school holidays and the August reporting season, and that's given us a chance to think about and debate how Australian companies are funded and by whom, and whether that needs to change as we all get older and financial markets get more mature. Anthony, there's been a few events this week that you've been lucky enough to be inside of, representing the Chanticleer team and our dear listeners, and to hear the debate and try and sort through all the various interests that inevitably get pushed. Let's start with the first event, which was a lunch with the lot hosted by one of our richest Australians, Visy Executive Chairman Anthony Pratt. Anthony, this was a cast of thousands and a cast of stars. Tell us a little bit about what happened inside this room.
I think this is the most unique event on our calendar, James. It's unlike anything else out there. So Viz is one of the great Australian success stories. I mean, you would have been writing about the Pratts for years, James, I imagine, the former Rich List man you are. So you had Richard Pratt, now Anthony Pratt, big packaging cardboard group in Australia, cracked it over in the US too. Now, Anthony Pratt says that they could only expand 20 years ago because of their access to private credit, or basically money out of the pension funds, which was arranged by this financier called Mike Milken, who's this big name investment banker, leverage markets guy who's sort of been doing this stuff for 50 years.
Legend.
Exactly. So Pratt says that this money that meant that Visi could expand aggressively, but also stay in the family's hands, stay in private hands. They didn't have to list. They didn't have to go to public markets. They weren't beholden to banks all of a sudden. And he wants other companies to be the same. So he sees Australia's $3.9 trillion pool of superannuation savings and wants to match that with all those other businesses that need, those other growth companies that are looking for investor to come in, be that debt or equity, these family-owned businesses that want to grow, but they don't want to give up control of the company. So he's trying to match this big pool of superannuation savings with these supposedly capital-hungry, mostly private businesses, and just get that flowing a little bit better.
Yeah, now Pratt's a bit of a magnet, Anthony. You mentioned Mike Milken was at the lunch, but that was probably just a slice of the high-powered heavy hitters in the room. Who else was there, and what did they have to say about this sort of Pratt's grand plan?
We got former Prime Minister Paul Keating. So he's been leading this charge with Anthony Pratt. I think it's the 7th year we've had this roundtable, and Paul Keating's sort of been at each one, and he's really keen on the super funds investing into private credit. He thinks they've got a bit greedy, just chasing the big returns on offer in equities, and they haven't actually been thinking about their members who are getting older and are going to be increasingly after yield, not just growth. So he was there. Michelle Bullock was there, the RBA governor. She got she did a bit of a 5-minute keynote on the economy, and I can report, James, that what she says behind closed doors is similar to what a RBA press conference is like. It was, she just talked us through the economy. All the stuff you hear in those press conferences. So yeah, we had Milken, the US banker, who came with 406 slides.
Wow.
I think he could pretty much talk through any question that was asked on his slide pack. He must travel very prepared for all sorts of occasions. So everything from financial markets to demographics to M&A volumes, you name it, he had it covered.
Fantastic.
So we had representatives from the banks as well. We had Westpac's and NAB CEOs. We had the CFO from ANZ. We had Macquarie represented too. We had the super funds, Hester Australian Super, asset managers like IFM, Tanara, QIC, the regulators. We had APRA's John Lonsdale there. It really was a who's who, 25 people sitting around listening to this stuff.
Tell me, Anthony, did you walk out of there thinking, you beauty, we've got a great solution to the world's problems, though?
Well, the only person, there's sort of two people at the lunch that see a problem. So that's Pratt and Keating, right? Yeah. Everyone else is there because Anthony Pratt's invited them. It's a really great, it's a great way to see how sort of how it works and how all this stuff works. But I think the banks already think that they do this, right? So, and they do. So the banks take deposits, right, which are effectively Australian savings, and then lend them out to other businesses. So they feel like they're already playing this role in the economy. They're a little bit worried about private credit, want to work alongside private credit, think there's room for them, wouldn't mind seeing the super funds coming in heavier because the banks can arrange those deals and collect fees. So yeah, I mean, they're up for it, but a little bit unsure. The super funds themselves, I mean, they're just, the first thing they always say to these calls, James, guess what it is?
We'll only do it if it's in our members' best interest.
Exactly, it's returns, right? So they're there as long as their returns are there. The asset managers love it, right? Because this is a whole new potential business line for them. They can take money off the super funds and lend it into private credit. So I think, no, to answer your question, we don't really walk out of the lunch thinking that there's this problem, if it is a problem, is about to be solved. But I think it's happening naturally anyway, to be honest. As Australians are getting older, I mean, I noticed it just this year talking to the super fund CIOs compared to last year's, what they're talking about, how they're thinking. They are more thinking about that yield and about that liability profile they've got coming up. So I think it is happening, but it's not like those CEOs were walking out of the lunch and then just turning on the taps straight away.
Yeah, fair enough. Anthony, you're at another discussion between the head of ASIC, the CEO of ASX, and Guy Fowler, one of our top investment bankers. What was the thrust of this conversation?
This one was right up my alley, James. and listeners will know it's one of our hobby horse topics, the sort of de-equitization in public markets, the shrinking ASX, that private capital winning over public markets. A big part of it is the IPO market and whether we can get more companies listed. Not that necessarily will solve everything, but it could help. Now, Guy Fowler is co-head of Barrenjoey, one of the new Australian investment bank. He's worth listening to on this topic. He's an ECM banker who sort of helped change the way that listed companies raise capital 15 years ago. And now listed companies can go out to shareholders with a rights issue and raise a bucket load of money pretty much overnight, whereas in the past it'd take them weeks. So he had a couple of potential fixes to the IPO market. He came out and said, let's maybe rethink prospectus forecasts, which would make it a little bit easier for listing companies to sort of get their numbers out there.
Makes sense.
I mean, he didn't say this on stage, but maybe if they could use a range on their forecasts, they'd be like, profit next year will be 40 to 50 million bucks, which gives them a little bit of a margin for error, as opposed to if they say it'll be $45 million. And he thinks the timelines could be a bit quicker too. They could speed it up a couple of weeks. If all the prospectus and everything was pre-vetted properly by ASIC, it would make it a bit shorter, take some of the risk out of that listing process for both the listing company and the investors, and it might just sort of help move it along a little bit.
We saw, of course, a few weeks ago, the Flying Burrito brothers at Guzman y Gomez got away a very successful IPO. Is your sense that there's a pipeline of companies ready to on the sidelines who also want to float?
There's definitely a pipeline of companies that want to float. The question is, are they any good? And will they be priced in a way that investors want to buy into them? So I don't think we've solved that problem, because at the end of the day, floats live and die on price, and investors have to think they're getting a bit of a bargain, and the people listing them have to think they're getting a good deal too. So bridging that gap is still the number one issue out there. But if we tinker with some of these other things, that can help bridge that pricing gap by just changing the risk profile a little bit.
Yeah, it'd be fascinating to see if those changes start to get through. This would be while we're waiting for the next batch of IPOs, this would probably be the good time to make those changes. So let's see where we go. All right, Anthony, we're going to come back after the break and look at the biggest data release of the year, June quarter CPI out on Wednesday. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and the best bits of this podcast and delivers them straight to your inbox. All right, Anthony, Australian earnings season gets underway this week slowly. We've got ResMed on Friday. We've got Rio Tinto on Wednesday. Pinnacle Investment Management on Tuesday. Then we go into the US Federal Reserve interest rate decision. We'll probably get that Thursday morning our time. Mm-hmm. I think everybody expects them to be on hold, but we might get more information about when that first cut is coming. But all eyes, Anthony, Wednesday, 11:30, June quarter inflation data is going to be out. Now, the RBA wants a soft figure here. It was 3.6% last time, but if this inflation number comes in hot, we could be looking at one last rate hike.
That's right, James. Big number here means rate rise almost certainly next week, doesn't it? So let's see what happens.
Yeah, my prediction of on hold till 2025 may be under threat. So we'll be watching that closely. Well, we love questions here on the Chanticleer podcast, and this week our question's from Jacob from Perth. If you've got a question that you want to send in, you can email us at chanticleer@afr.com. You can send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us, and that's exactly what Jacob's done.
G'day, Chooks. Jacob from Perth, WA. Big fan of the podcast. My question is regarding a hot topic in financial circles, being private credit. An article was published this week from a well-known publication around the private credit market and the concerns raised by the regulatory bodies, ASIC and APRA, around the volume of funds that are flowing into private credit. And I just found it interesting that I guess the involvement of the superannuation funds in this sector, being unregulated and where they largely operate in a regulatory environment, is there potentially a bubble forming with assets in the private credit market? And if so, what could potentially bring that unstuck? Interested to know. Look forward to hearing from you.
All right, Anthony, I'm going to have first crack at this. Okay. I talked to two heavy hitters from the super sector this week about this very topic. I mean, every second email we get at the moment seems to be about private credit, and I think it's exactly the same for anyone inside a super fund. They are cautious about the idea of a bubble for two reasons. One, everybody's talking about it and everyone seems to be doing it and everyone says it's a great idea, which generally means be careful of the other side of that trade. I think the other thing they're concerned about is that not everybody rushing into the private credit market has lots of experience in it. This is a fairly new sector. And not everybody who is in private credit has experienced the full cycle. So they haven't been in private credit during a downturn. So for all that, though, they are feeling okay about the fact that we're not in bubble territory. Credit spreads are still pretty good. So you can still get, in European private credit, for example, 600 basis points or 6% over the basic interest rate out of your European private credit investments. So, you're getting up towards double-digit returns. What super funds are watching for is if there's so much heat in private credit that credit spread starts to come down. So if it came down to, say, 300 basis points or 3% over the prevailing interest rate, that's when super funds are going to get worried that there's so much money rushing in here that returns us, the compensation, the return that you're getting for taking on the risk is starting to be bid down. So I think at the moment, Anthony, the bubble conditions aren't there. But it is very interesting to me that everybody is on the lookout for a bubble. Is that tally with what you're hearing?
Hot topic, Jacob. I mean, I heard both the ASIC chairman and the APRA chair talk about this exact topic this week at those events we were just talking about. So it's definitely something they're looking about. ASIC's even running around talking to market participants at the moment, just trying to work out whether this whole private capital train's going versus public markets, what the implications are, what the risks are for the system. So, Jacob, it's very much on their agenda. All of these things, it feels like it's hot at the moment. It's going to get to the point where it runs too hard, and then the market will sort itself out a bit. Start to put the CIOs at the super funds will start putting their money elsewhere, and it always acts as a little bit of a leveler. I mean, in terms of the bubble, the one thing it's got to be a little bit concerning is if you look at where private credit is heavily used today in Australia, it's in the construction industry and in commercial real estate. Historically, that's the one part of the market that tends to bring the banks undone, and that's why the banks got out of it. So, I mean, it is worth watching. It is worth thinking about. Great question, Jacob.
Yeah, Jacob, I'd really take some heart from the fact that everybody is thinking about this question. That's usually a good sign that no one's going to get too far over their heads, we hope. Well, Anthony, thanks for a big week. Can't wait for the inflation data next week. It's going to be very exciting. And hey, we've got a special guest next week too that's going to be really good.
Can't wait, James.
See you next week. If you like the podcast and want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.